Welcome to The Explainer. We're talking about gold. It's this global obsession, right? But how does it actually get its price? That's what we're going to do today. We're going to trace its whole journey, from that big global number you hear about, all the way to the little price tag you see in a store.
You've probably seen this happen, right? You'll see the gold price on the news, maybe something like $2,100 an ounce. But then you walk by a local jewelry store and the price is completely different, say 6,700 rupees per gram. It feels like two totally separate things, doesn't it?
So, in this explainer, that's exactly what we're going to do. We're going to connect those two dots. We'll break down exactly how that big global benchmark number turns into the final price you actually pay. All right, let's dive in. Okay, first things first. We have to get something straight. There's not really just one gold price. The one that's the most important, though, the one that's kind of the foundation for everything else, is what the market calls the spot price.
So what is the spot price? Well, think of it as the right now price. It's what you'd pay for gold if you wanted it delivered, well, immediately. And it's always quoted in US dollars per troy ounce. By the way, a troy ounce is just the standard for precious metals. It's a little bit heavier than your everyday ounce. But the key thing is, this is the global starting point. Everything else builds on this number.
Okay, so what makes that global spot price tick? What pushes it up or pulls it down? Well, it's definitely not random. It's all about some really big, powerful forces in the global economy. The first piece of the puzzle you have to get is that gold is priced in US dollars, everywhere. And that one simple fact creates this really interesting seesaw effect with the value of the dollar.
And here's how that seesaw works. Imagine the US dollar gets weaker. All of a sudden, for someone buying gold with, say, euros or yen, gold just got cheaper. And when something gets cheaper, what happens? More people want to buy it. That extra demand tends to push the price of gold up. It's this classic inverse relationship. When one goes down, the other tends to go up.
All right, next up is something called the real interest rate. Now, think about it. Gold's biggest weakness is that it just sits there. It doesn't pay you any interest, not like a savings account does. But what if the interest you're getting from the bank is actually less than inflation? Well, then your cash is literally losing its buying power. And in moments like that, holding a physical thing like gold, which doesn't really cost you anything to just hold on to, suddenly looks like a much better deal.
And believe me, it doesn't stop there. You've got people buying gold because they're worried about inflation down the road. You've got them flocking to it as a safe haven whenever there's a crisis somewhere in the world. And then you have central banks, we're talking governments here, buying it by the literal ton to spread their risk. All of these different things are constantly pushing and pulling on that one global price.
So, we've talked about what moves the price. But now, where does this all happen? Where is the price actually made? Let's take a look at the real-world markets and the big players who actually set this global number.
So who are the buyers here? It's actually a pretty diverse bunch. I mean, you've got central banks making enormous purchases. You have these huge investment funds, you might have heard of them, ETFs, that hold actual physical gold for their investors. And then, of course, you have the more obvious ones, jewelry manufacturers and even industrial companies that use gold in their products. It's a whole complex ecosystem.
And look, the price isn't decided in some secret back room by a handful of people. It's constantly being discovered, through millions and millions of trades happening in major hubs like London and New York. All of that action kind of comes to a head in the daily LBMA Gold Price auction. That's what sets the key benchmark that pretty much everyone, from the biggest banks to your local jeweler, uses as a starting point.
Okay, so now we've got our global price. Let's shift gears and get into the math. How do we take that number, the one in US dollars, and turn it into the price you'd see in your own local currency?
To make this super clear, let's use a real example. Let's just lock in a number to work with. We're going to start with a global spot price of, say, exactly 2,100 US dollars per troy ounce. The very first step is just some simple math. You take that spot price in dollars, you multiply it by whatever the current exchange rate is for your local currency, and then you divide the whole thing by about 31.1. Why? That's just to convert from ounces to grams. And boom, just like that, we have the basic price for the raw metal, but now it's in our local currency.
Okay, now for the fun part. The final layers. This is where that raw number for the metal itself gets transformed into the actual price tag you see glittering in a store window.
So once we've got that base price per gram, the costs just start stacking up. First, you've got to add any import duties that your government charges.
On top of that, you add local sales taxes, like GST or VAT. And then finally, the jeweler themselves adds what they call making charges. That's for the artistry and work involved, plus their own markup, of course, to cover their costs and make a profit.
Let's actually see how this plays out with our numbers. We start with that base price, which was around 5,600 rupees. Then we add a 12% import duty, bam, we're already over 6,300. Next, we slap on a 3% GST, and that pushes us up to about 6,500. And a final making charge takes us to our final retail price of over 6,600 rupees a gram. It really shows you how fast all those little things add up, doesn't it? So, the big takeaway here is this. When you look at that tiny price tag on a piece of jewelry, just remember what's packed inside it. It's a little bit of global economics, a dash of international market mechanics, and a whole lot of local costs and taxes that get piled on right at the very end.
And that pretty much wraps up our explainer. It's a really fascinating journey, isn't it? From this huge global signal all the way down to a local price tag. It kind of leaves you with one final question to chew on, though. In a world that's all about digital assets and things you can't even touch, why does this one physical yellow metal still have so much power?